Hello and welcome to this edition of Frank and Mickey Talk. I'm Mickey and this is Frank Montez from Torrey Pines Financial. And today we're going to be talking about the review process, specifically as it relates to permanent life insurance policies. So welcome, Frank.
Good morning.
So what we're going to talk about today is focusing on the annual review, the mid-year review process of permanent life insurance. But before we go into that, if you want to give us just kind of a brief overlay of the differences in life insurance policies that are out there.
Sure. I would say there's two basic categories. There's term insurance, which actually comes from the word temporary.
Okay.
The characteristics are very low premiums, guaranteed for a period of time, not to go up the premium. Death benefit stays the same. And at some point after that guaranteed premium portion, the rates go up a lot, like tremendously.
Okay.
Permanent insurance starts off with a higher premium. It has a component where money will be returned to the policy if it's designed properly and have a cash value buildup, and the death benefit is designed to stay in place for your entire life. And during that time, that equity buildup can be used for different reasons in life, sometimes to assist you in retirement. So permanent contracts, larger premiums, cash value buildup, hopefully designed that the insurance is there in the later years, term for a temporary need.
So if clients are out there and they've purchased a permanent life insurance policy and they're a couple years into it, why is it important for them to revisit it now and annually going forward?
Sure. So there's no other way to illustrate a policy for the long term other than linear, meaning that there's assumptions we make when we plug in these, what we call illustrations. So we'll put in how long a person wants to put premiums in.
Okay.
We have to run an assumed rate of return, whether that's 5%, 6%. Nowadays, it's usually something lower. We try and be conservative with the assumptions. But whatever it is, we know that markets don't run linear, and all of these policies have some underlying investment component, all of them, whether it be the portfolio of the insurance company itself, or an outside index, or in variable life contracts, it could be outside mutual funds, whatever it is. So if we run an illustration, it's going to be linear. It's never going to perform like that. So you should check on it, at least, on the anniversary every year, run what's called an enforced illustration. That's asking the insurance company to say, what's my policy doing today? I understand I bought this in the hopes of this happening, but an enforce says, tear up that original because it's a year later and we know what we proposed didn't happen. How's it working today?
So obviously markets are going to change, conditions are going to change, so that's one reason to review. Another thing that we talk about often is how the policy is actually set up and if it was done correctly. So what does that review process look like for clients out there?
So an excellent question. I think you have to understand a little bit of the history of the permanent contracts and why it's an issue now. Is in the late 1800s when permanent policies existed, there basically was one type of contract. It was called a whole life contract. And whole life had three guarantees. A guaranteed premium couldn't change up or down. The death benefit would always be at least the minimum as to what you purchased, and your cash value was guaranteed to accumulate, usually like at a 4% rate of return. So fast forward to the late 60s, where the industry wanted to come up with a solution. Whole life premiums were here, term premiums were here. They wanted to find a place in the middle where you could have a permanent contract, but not pay whole life premiums. That was the creation of universal life chassis, as I would say. There's different types of universal life. But the bottom line is what people didn't know. They said, yeah, you could pay less, but they didn't realize that the guarantees went away and the insurance company could change the components of the plan at any given time. They could change what they were charging for mortality, they could change what they were charging for taxes, for fee structures. And so a lot of these policies, a lot of the whole life policies got replaced, and in reality what we found out later is that there wasn't enough premium in these UL contracts, universal life contracts, to stay alive as long as the whole life policies were. And so now we look at these policies today and we get an enforced, and we start to see that I just had a situation where a 36-year-old has a 15-year-old policy. If he continues the same amount of premium, it's going to lapse in 10 years. So it's functioning as a term policy, but he's paying a lot more for premiums.
Okay. So when you're reviewing these, that's something, and that the client should be looking at, something that you're going to look at is, theoretically, if it's a permanent policy, the number one thing we're going to look at is how long are they going to be covered with a death benefit?
Yes, and you could look at based upon different premiums, right? Whether they're continuing to pay the same amount, if they stop paying premium, will they need more premium? So these are the discussions you have to have because things change.
And when you talk about a policy not getting set up correctly, you said it's underfunded. What does that look like for the end user besides just the life insurance maybe lapsing much sooner than they think?
Well, typically the lapse of the death benefit will correlate with the cash values going down to zero.
Okay.
So that could be a real shock that they may have set up the plan to have some assist with retirement income, and all of a sudden not only do they not have insurance, but this pot of money that was supposed to be there is basically whittling away because there wasn't enough premium going in. Or you could say the amount of premium going in, they had too much insurance, because one way you can control how that pot grows is correlate the amount of premium to the amount of insurance, because obviously there's cost for insurance. So there are some designs where people really, the insurance is secondary. They want to fund this contract to take advantage of the tax deferred growth and the tax-free distributions using borrowing provisions. So a lot of people don't realize, but the whole corporate world, deferred compensation is all funded with permanent life contracts, but designed properly. So that's the issue.
So when a client is going in, you want to definitely have the conversation of what are your goals for this policy? Because these policies can do a number of different things, right? They can obviously offer permanent life insurance protection if you have a need, but then there's those that it can also offer some sort of retirement benefit. Should a client really choose one or the other when they're setting these policies up, or can they have kind of the best of both worlds?
They can have the best of both worlds, but there has to be the discussion and the understanding of a couple things. Depending on the design, there could be a commitment of a minimum of years. What I mean by that is, I see a lot of people were told, oh, I could fluctuate the premiums here. And so they get that in their mind, and we're finding that they're stopping premiums, and then the result is an early lapse policy. I usually will let them know that we want to fund this, although it is optional, or it is flexible, I should say. There's a minimum of time that we need to have premiums in there, or this policy is not going to function, and those early years are critical. So we try and design it so, this is an additional benefit. We want to come up with a premium that they're comfortable with, and nobody knows the future. We could change, but going in that, hey, I'm committed to at least whatever it is, 10 years, 12 years, 15 years of premiums, so we can get the desired result.
When you're advising clients that are either your current clients or coming to you as a third-party specialist, how often should people be reviewing these policies?
We try and look at ours annually. People get busy. We'll call for an annual review, and a lot of times it doesn't happen, to be honest. But we're getting an enforced illustration on all our policies on an annual basis and taking a look internally if the client doesn't have time to meet. Most of the time they will, but reality is people get busy. If there was any concern with the contract, then I would reach out to them and let them know that it's urgent to meet. But as I said, the key is to get it set up properly, so we don't run into a lot of problems with our contracts, quite frankly, because they're set up properly.
For those folks out there that maybe had a permanent life insurance that they bought 5, 10, 15 years ago, and they're watching this video wondering if their policy was set up correctly, I guess the question is how challenging is it to have a review? Like, how much work is it on the client's behalf? Is it easy? Is it quick? What's it look like?
It's easy. The document you need is called an enforced illustration. What that means is the insurance company made an offer to the insured with some assumptions, and the day one that's purchased, fast forward a year, well, things changed. A lot of things didn't happen the way they were proposed because, as we spoke about, markets move. So you order an enforced illustration saying what's happening today, and it gives you an updated version of that contract. So there's two ways to do it. Since we know the language, there's a form that a client could sign that allows us just to call the insurance company on their behalf and order that document and get it sent to us or to the insured. Or we could explain to the client what you're looking for and you call the insurance company. But a lot of times you can get run through the loops or it gets illustrated incorrectly. So I would say 9 out of 10 times anyone that's reviewing with us will give us the authorization to call on their behalf and simply order, may I have an enforced illustration? We'll ask for these current assumptions, continuing to pay premiums, stopping premiums, rates of return, taking money out. How will this look? And so It's not a difficult process, but there is definitely some work to be done.
Okay, excellent. And before we close out this video, is there anything else to the review process that you would want clients to understand out there as they're looking at their permanent life insurance policies?
Sure, I think that like every other industry that there's been some changes in the design of the contract, which allows a broker to change the fee structure. And obviously if fee structures are lower, that's a benefit to the insured and the cash value. And there's been some changes in the last 10 years that we could take advantage of things like that. So I'm not sure everybody is aware of that. So it's definitely taking a look at these policies. As I said, it's kind of mind-boggling to me how rare it is for me to pick up a policy and not find some way to either improve upon it or I bring something to the insured's attention that they weren't aware of.
Yeah, excellent. Well, great. Thanks for joining us on this episode of Frank and Mickey Talk. We are going to continue this discussion about the review process, especially as it relates to term life insurance. If you like this video, drop a like down below. And as always, subscribe if you are not yet subscribed. Thanks for joining us. We'll see you on the next episode.
Have a good day.